Pause. Imagine a busy port. The giant cranes stand still against the sky. A massive container ship sits idle, stacked with containers. Engines hum low, anxious. No one is unloading them. No one can pay the fuel bills in the usual way. Digital payment systems that grease global commerce have seized up. This quiet pause, one broken link in a very long chain. Factories in distant lands begin to slow production lines. Cargo sits idle in vast warehouses. Supermarket shelves begin to show empty spaces. This is not a scene from a disaster movie. It's one plausible, quiet way the world might look if the US dollar lost its preeminent place. For decades, the global economy assumed the dollar is the default, trade's language, finance's bedrock, a safe harbor. Ahead, the baseline, then bond market stress, banking feedback loops, inflation and petrodollars, sanctions and shifting alliances, the lessons of escalation and the long-term new reality. We'll follow the chain reaction, step by step, through mechanisms you can see. Today, many countries use the US dollar for their largest cross-border transactions. When Japan buys oil from Saudi Arabia, prices are almost always quoted and paid in dollars, not yen or reals. This isn't law, but a powerful convention hardened over years. Banks and nations hold vast dollar reserves as liquid protection against shocks and to facilitate trade. This status grants the US exorbitant privilege. Global demand for dollars keeps borrowing cheaper and finance smoother, while concentrating power. But what if nations and corporations prefer euros, yuan, or new digital money for their biggest deals? The global architecture runs on dollar rails. Contracts, software defaults, trader habits, central bank routines. Switching isn't overnight. Friction and deep inertia slow change until something accelerates it. We'll trace the first signs of trouble to their cascading effects. First, what would fail earliest, like the market for US government debt, then how banks strain and how geopolitics realign. After World War II, Bretton Woods made the dollar the central pillar, linked to gold. In 1971, that link ended, yet the dollar remained dominant. Oil priced in dollars sustained global demand. First signs appear in trade patterns. Countries test other currencies in bilateral deals. Treasurers ask for alternatives to reduce dollar exposure, hedging sanctions, risk, and future value. Not collapse, hairline cracks. Signs the world is cautiously hedging beyond a single anchor. Enjoying clear, cause and effect breakdowns? Tap like to support the work, drop a comment with your take on the first cracks you'd watch for, and subscribe so you don't miss the next scenario. Small currency shifts ripple through invoices and shipping finance, reaching ports, factories, and households. That quiet pause at the port is a symbol of disruption brewing in the system's plumbing. For decades, foreign demand for treasuries kept US interest rates low. If demand for dollars falters, investors shift to other safe assets, bonds, perhaps even credible digital instruments. Treasury prices fall, yields rise to lure buyers. Higher interest costs crowd out other spending. Yields transmit to mortgages, car loans, business credit. The pain reaches households. International banks holding dollar reserves face volatility and scarcity risk. They scramble for dollars and pay a premium. To raise cash, they sell assets, stocks, then bonds. Sales push prices down globally. A feedback loop forms. Currency stress forces sales. Sales cut prices. Losses force more sales. The global network amplifies the shock. Weak links pass strain to others. That's the risk. Financial plumbing under pressure becomes a system problem fast. As confidence shifts, the dollar likely falls against peers. Exports get cheaper, imports get pricier. Electronics, clothing, coffee, car parts, all cost more in dollars. Higher import costs pass through to inflation. The Fed's standard tool is higher rates to cool prices, but tighter policy risks slower growth and job losses. A painful trade-off. Since the 1970s, oil priced in dollars created structural USD demand. If major exporters price in other currencies or a basket, that pillar crumbles. Exporters accumulate euros and yuan instead of dollars. Less recycled petrodollars means less buying of treasuries. Yields climb. Energy invoices in new currencies require rebuilt, trusted payment rails. New platforms owners gain. USD clearers lose significant revenues. Because energy, shipping, and banking are tightly coupled, a currency switch in oil radiates through the whole system. A weaker dollar shifts alliances. Regional blocs strengthen and route around U.S. finance. Fragmentation adds legal and payment friction. Trade gets costlier. International savings no longer center on treasuries. U.S. borrowing costs rise. Sanctions work because dollar rails run through U.S. banks. If alternatives grow, choke points weaken and sanctions get harder to enforce. Some nations gain room to maneuver, yet a more complex system becomes more fragile under stress. More independence, more complexity, greater systemic fragility. The simple dollar era gives way to patchwork rules and rails. Next, how quickly stress can escalate, and what history shows. Ending gold convertibility in 1971 ushered in years of currency volatility. In 2008, stress jumped borders fast. Networked finance transmits shocks quickly. When belief breaks, rational selling becomes a stampede. Markets move in seconds. Invoices can shift in months, reserves in years, treaties in decades. Fast shocks collide with slow institutions. Outcomes get messy and hard to predict. Initial panic may fade, replaced by a long adjustment. Lower growth, higher uncertainty. It's not a single crash, but a multi-stage process, defined by policy choices, capital reallocation, and new norms. Over time, systems adapt. People and institutions build new habits, and new rails. Instead of one king currency, a multipolar state likely emerges. Some win, new hubs and rails, while trade friction and financing complexity rise. Smaller economies, lacking safe assets, face tougher choices between blocs. The U.S. adjusts, negotiating to preserve dollar rolls or doubling down on lasting strengths. Systems built on a single anchor are efficient and fragile. When trust shifts, finance triggers energy, trade, and geopolitics, touching daily life. Imagine that port again. The ships are waiting, the workers are watching. That quiet pause holds the lesson. Small changes in money's rules set powerful real-world chains in motion. If this breakdown helped clarify the stakes, like the video, comment with your next what if, and subscribe to explore more realities with us. What scenario should we explore next? Share your ideas below. You've been watching Ifverse, where imagination meets possibility. See you in our next reality.